Welcome back to the Deep Dive. Today, we are cracking open the blueprint for, well, for enduring wealth. We're taking a deep dive into the specific sophisticated structures that South African investors use to protect massive property and business portfolios.
This really is the essential difference. The difference between building wealth that lasts one generation and wealth that lasts three or more.
Right.
Property investment is fantastic. I mean, bricks and mortar, they deliver reliable returns. But we've poured through sources detailing how structure matters just as much as the asset itself. The goal is preservation.
Our mission today is to unpack the architecture of that protection. We're going to reveal what separates those who build an empire from those who, well, lose it to an unforeseen lawsuit, a catastrophic claim, or the inevitable sting of estate duty.
And we can jump right into the core risk: concentration.
Concentration.
The biggest threat to any substantial portfolio isn't the market, it's not even the tenants. It's the risk that one single problem can cause a catastrophic chain reaction and bring down an entire holding.
And we see the sources lay out the solution: the asset protection fortress. Okay, let's unpack this. Before we assemble the fortress, we have to look at the foundational weaknesses it's designed to guard against.
The initial, and I mean the most obvious flaw, is simple personal ownership.
Just holding it in your own name.
Exactly. Holding investment assets directly in your personal name exposes you entirely. We're talking direct exposure to creditor claims if a personal business fails, any major lawsuit you face, and of course, the split in a high net worth divorce settlement.
That much is, I think, pretty intuitive for most people. We know personal ownership is risky. But if that's out, what's the next most common mistake people make when they try to move away from that?
The next major pitfall is what we call concentration risk 2.0. It's using a single legal entity, so a single company or a single trust, to hold multiple properties, maybe 10 or 15 assets all in one basket.
It feels like protection, but it's not.
It's a time bomb.
So why does that fail? Why does using a single trust or company fail when you're dealing with multiple properties?
Because if that one entity owns 10 properties directly, and that same entity is also handling all the day-to-day operations,
Signing leases, hiring people.
employing building managers, contracting for maintenance, it exposes all 10 of those assets to the operational liabilities from just one of them.
Give us the concrete example from the sources. That really illustrates this.
Okay, picture this. That single trust owns a portfolio valued at, say, $50 million. A catastrophic incident happens at just one building, maybe a serious structural failure or a large fire.
And the insurance doesn't cover it all.
Precisely. The claim for damages exceeds the insurance coverage by, let's say, $15 million. Because the trust owns all 10 properties, that $15 million liability attaches to the trust itself. Legally, the entire structure becomes security for that one failure.
So the claimant, or the bank, can potentially attach a judgment to any of the 10 properties to get that $15 million. The entire portfolio is now at risk.
That's it, the entire portfolio. That vulnerability is what necessitates a multi-layered, triple-tier architecture. You have to have defined compartments.
And this is where we introduce the pyramid structure, the real secret sauce of long-term security. At the peak, you have the trust. In the middle, separate holding companies, which we call propcos.
And at the base, you have operating companies, or opcos.
Okay, let's build this from the bottom up, functionally. Let's start with that middle layer, the holding company layer.
The isolation layer, this is absolutely key.
So the trust owns the shares of the holding company, and that holding company owns the specific property deed. If I have 5 investment properties, I have 5 separate propcos, correct?
That's absolutely critical. One property, one propco. This achieves the crucial ring-fenced separation. The propco exists for one purpose: to hold that single deed.
Right.
So creditors pursuing holding company A, maybe due to a claim on property A, cannot easily reach properties held in holding companies B, C, or D. They are legally distinct entities.
It's like having separate surge protectors for every appliance in your house. So if the TV blows up, your fridge and your computer are safe. The propco protects the asset itself.
That's a perfect analogy. It limits the damage from any single point of failure to one specific legal container and its specific asset.
So the asset is safe. But what about the risk? Where does all the day-to-day chaos of property management, tenant issues, and maintenance contracts live in this system?
That moves us down to the base of the pyramid, the operating company layer. This is the liability sink.
The liability sink.
The opto is typically a standard private company, and it handles all the day-to-day activities that naturally create liability exposure. signing leases, employing staff, contracting with service providers like plumbers and security, tenant relations, all the activity and thus all the risk occurs here.
And the key is that the OpCo owns almost nothing. Minimal assets.
Exactly. It's handling the risky business, but it has no valuable property to lose. It operates through a formal contractual management agreement with the PropCo. This is what cements its status as the primary entity exposed to claims.
So if a massive claim comes in, say an employee is seriously injured or a major contractor sues for breach of contract, that claim attaches to the OpCo.
That's the mechanism at work. If the claim is catastrophic and even exceeds the OpCo's insurance, the OpCo may legally fail. But because it only owns a laptop and maybe some office furniture,
The loss is contained.
the loss is completely contained. The valuable property in the PropCo remains untouched, and you simply establish a new OpCo to take over management.
Here's where it gets really interesting. Let's look at the practical human impact by contrasting two investor stories from the source material, Temba and Lorado. This is the difference between structure as a nice idea and structure as a lifeline.
Temba built an impressive R45 million portfolio over 20 years, a great achievement, but his structure was disorganized,
A bit of a mess.
a bit of a mess. Some properties in his personal name, some in a single company, some in a trust he treated like his personal bank account. When he faced $10 million in claims following a devastating fire tragedy, those claims attached to his personal estate and his single company.
And the consequence of that.
Cascading destruction. He lost 4 of his 8 properties and spent millions in legal fees trying to fight claims that shouldn't have been linked in the first place. His lack of compartments cost him half his life's work.
Just devastating. Now, contrast that heartbreak with Lorado. She built a similar R45 million portfolio, but implemented the comprehensive structure.
She did it right from the start. A trust, 8 separate propcos, and 8 separate opcos. When Lorado faced an R8 million fire claim at one of her residential blocks, the structure contained the damage entirely.
So it worked as designed.
Perfectly. The claim was directed only against the operating company that managed that one damaged property. The other 7 properties, each in their own separate propco, remained completely protected. Lorado suffered a business incident. Temba suffered a portfolio-wide crisis.
This dramatically illustrates why using a separate company for each asset and separating the asset holding from the operation holding is so crucial if you combine them.
You create cross-contamination risk.
You're right back where you started.
You've just reintroduced the domino effect. That minor additional cost of maintaining separate companies is the price of true security. You're paying to ensure your dominoes never, ever chain together.
So we have isolation and liability containment taken care of. Now, we circle back up to the peak of the pyramid, the trust. If the corporate structures handle the day-to-day risk, what unique generational and tax protection does the trust provide that the companies simply cannot?
The trust provides the vital generational benefits and the ultimate apex protection. Crucially, corporate structures alone do not remove the asset from your personal estate for estate duty purposes.
Let's focus on that for a second. Estate duty. For listeners who are building substantial wealth, this is one of the biggest costs of death.
It is a massive erosion of wealth. When the trust owns the shares in the holding companies, those assets, the shares representing the property wealth, are removed from the founder's personal estate.
It's no estate duty.
No estate duty on those assets, but we also bypass those often overlooked executor's fees.
Wait, what are executors' fees and why is avoiding them so impactful?
So executor's fees are the costs charged by the professional or the bank managing the deceased estate. They are calculated on the gross value of the estate, and they can run as high as 3.5% plus VAT.
On the entire portfolio value.
On the entire value. For a R45 million portfolio, that's over R1.5 million. Just pay out to administer the estate before the assets are even distributed. A properly structured trust avoids those fees entirely.
That is a massive saving for the next generation. And beyond the money, the trust ensures operational continuity.
Seamless operations. If the founder or a trustee dies, the trust itself, as the shareholder of the propcos, hasn't died. The remaining trustees continue operations without any legal interruption. This avoids the delays, the paralysis, really, that can happen when winding up a deceased shareholder's estate.
And what about that final layer of protection against the founder's personal problems?
Well, if the trust owns the holding company shares, personal creditors of the founder face significant legal barriers. The assets legally belong to the trust, not the founder, making the pursuit of those assets highly impractical.
And finally, family protection, which I think is often the heart of the structure.
It is. Trust deeds, especially discretionary trusts, allow you to exert precise control over distributions. This protects the wealth from the beneficiaries' poor financial decisions, their creditors, or, crucially, their future divorces. You're securing not just your capital, but the financial future of the people you care about.
Okay, this structure sounds incredibly powerful, but I can hear the listener thinking, that sounds like an administrative nightmare, and it must be unaffordable.
I mean, Lorato's structure involved 17 separate entities for her 8 properties.
Yes, and the sources address this directly and logically. Sophistication brings administration, there's no way around it. For a substantial portfolio, say R35 million, you might be looking at 7 to 10 entities.
Which means professional support.
It requires professional support for compliance, financial statements, annual company registration updates with CIPC, and tax returns.
And the annual cost for that kind of professional management, what are we talking about? It can range, depending on complexity, from maybe R75,000 to R150,000 annually. And I know that sounds like a lot to a starting investor.
It is a lot. R150,000 is still significant. Is there a point where the administrative cost outweighs the protection, especially for someone who only has 2 or 3 properties?
That's a fair question, and the answer is nuanced. For a starting investor, yes, complexity must match asset value. But once you cross that threshold where a single catastrophic claim could destroy a substantial portion of your net worth, the cost becomes irrelevant.
It's just the cost of doing business at that level.
Our sources call that R150,000 annual fee modest insurance. Remember Temba's R2 million in legal fees and 4 lost properties? That's the invisible cost of inaction. The administrative cost is visible. The disaster cost is devastating.
What about financing? Do banks shy away from lending to these complex architectures?
No, the opposite is true. Banks are very familiar with this. They regularly finance trust-owned and company-owned properties and view this structure as highly sophisticated. They secure the mortgage against the specific propco, and yes, they still require personal sureties from the founder or trustees. That's standard.
And the smart investor's choice regarding debt.
They insist on separate financing facilities for each propco, even if that means slightly higher interest rates or fees.
You maintain the ring fencing.
Exactly. You want to ensure that a default on Property A's bond does not automatically trigger a default clause on Property B's bond. You maintain that isolation at every level.
Okay, let's pivot to implementation. If someone has existing properties, they need to transfer those assets into the new holding companies. What about the significant cost of transfer duty?
Transfer costs are a big one. They can be significant once-off expenses that have to be budgeted for. However, the sources suggest smart solutions. You can phase the transfers over several years to manage cash flow.
Or what about Section 45 restructuring? That sounds highly technical.
It is, but it's critical. Section 45 group restructuring is a provision in South African tax law that allows you to move assets between companies within the same group without incurring transfer duty or capital gains tax immediately, provided the structuring meets some very strict criteria.
So it's a huge tool, but it requires expert guidance.
It absolutely requires expert guidance. This level of complexity is not a weekend DIY job with a template.
No way.
This is where an expert like a trust consultant becomes the missing piece. Someone like Lumka Sturman. Her role is vital. Translating this high-level strategy, the pyramid, into a working, compliant fortress.
It's about education and empowerment, then.
Completely. Simplifying the complicated legal and financial jargon and providing clear, actionable advice.
So a consultant acts as the expert guide to analyze your risk, design the custom blueprint, and ensure the structure is SARS compliant, which is crucial.
Exactly. They conduct a personal exposure analysis to spot existing weaknesses, design a cohesive asset transfer strategy tailored to your specific family situation and growth plans, and make sure the trust documentation is watertight. It's about creating confidence.
This raises an important question. After all this discussion of complexity and cost, what is the ultimate takeaway for the listener?
The structure provides clarity, confidence, and long-term security by fundamentally separating ownership from risk. When it's done correctly, you maintain functional control, but you shield your underlying capital. The operational risks are contained in entities designed to absorb failure, while the generational wealth is secured at the apex of the pyramid, ready to be passed on efficiently.
Final synthesis. You can budget for the cost of proper structuring. The fees, the transfer costs, the administration. It's visible and quantifiable. The cost of inaction is invisible until the catastrophic claim materializes, at which point it often exceeds everything you've built over decades.
You've committed capital, you've built something valuable. That achievement deserves protection that matches its value. Your portfolio deserves a fortress.
For listeners who want a focused conversation on designing their structure or identifying their specific exposure points, their own TEMBA moment waiting to happen, they absolutely must seek out an expert.
There's no substitute for professional advice here.
Lundke Sturman specializes in building these compliant trust company structures, offering services like the Foundation Audit and the Asset Protection Blueprint session to get you started on securing your legacy. You can learn more about her services at www.lundkesturman.com. Take the first step today.